Hey folks, thanks for tuning in to the Motor Research YouTube channel. The monthly Motor Checkup video is part of the Motor Research service, and the video that you're about to watch is actually last month's video. But if you want to watch the most recent video, head on over to our website at motorcmr.com, that's MOTRCMR.com, and sign up for a free 1-month trial. From there, you'll be able to watch the latest video, plus access all of our weekly research notes and chart packs. If not, you'll still be able to watch this month's video when we post it here for free next month. So be sure to subscribe so you don't miss it. And feel free to drop us a like and leave us a comment below or follow us on social media, as we'd love to hear your feedback. Without further delay, let's get into it. Welcome to the May 2024 monthly Motor Checkup. My name is Dave Lundgren, and I'm the Chief Market Strategist here at Motor Capital Management and Research. The theme for this month's video is essentially that we're bullish. We really do like what we see in terms of the bigger picture, longer term, despite all the macro headlines and concerns that are obviously that we're all wrestling with. But nonetheless, the market as it is right now, even the best of bull markets, the most robust bull markets, don't go up in a straight line, and there are times when they take a pause. And I think the key thing here, though, is that, and this is something we've been saying all along, is that this is a bull market, but it's not the most super robust bull market. And so for that reason, this is the sort of bull market where we should perhaps expect corrections along the way, and particularly when we have the evidence to support the idea that we should get one. And we wrote about this back in March, the idea of taking some profits, maybe adding some shorts, certainly not doing any further buying into that March high. We talked a lot about the divergences that were taking place, and the idea that if you wanted to get defensive or short, do so while it was overbought. And most importantly, should we get a correction that gets us down 5 or so percent, that's not when you want to start shorting. That's when you want to start buying. And so that was sort of the table we set for the following month or two. And so now we have the benefit of hindsight to now see that we did indeed get a correction. I think it was about 7% in a subsequent rally back across the range. And so what we're looking for now is, did we do enough repair work during that rally to reset the momentum of the bull market and get things going again, where we no longer have to worry about overbought and oversold conditions, where we can just go back to managing the portfolio and being less sensitive or less tactical about how overbought or oversold we are at any given moment. And of course, my take on that is that no, we have not done that repair work. So we're going to walk through that in some of the evidence and just how we're handling it and what we're recommending to clients. Before we go through that, let's take a quick look at the disclosures here for the month. Okay, so the idea, again, market is still not ready for prime time yet. So the stressing, this is most probably just at the outset, it's really important to stress that this is not bearish. We remain long-term bullish, and when I mean long-term, I'm talking about measured in months or quarters, or even depending on the strength of the bull market, which again, I said is not super robust right now. So, but when we're talking long-term, it could be as long as years. But the idea that this is, when I say long-term view, I'm talking about, beyond the next week or a couple of months. I'm talking bigger picture. The data supports higher prices in time. But as I said, even the most robust bull markets, they do have corrections. They don't go up in a straight line. And so when you get the evidence in support of a correction, that's just those windows of time is when we just really want to be mindful of that. And again, it's not that you want to adopt a bearish outlook or that you want to raise 50% cash and get net short. It's more just about being mindful of when you want to do the bulk of your buying and when you want to just do the bulk of your watching, if you will. And so obviously when you have this sort of tactical setup, which we think we're still in, we just want to be more mindful that we want to be doing our buying when we're oversold and doing our watching when we're overbought. And right now we're overbought. So right here we're bullish. We just this isn't the place to get all bulled up just because we've gone back across the range. We haven't seen the structural breaks that took place in April. They haven't been repaired. So we're back across the range. That's great, but we didn't get across the range in a manner that tells us that the momentum is back underneath the bull market again. And so I think there's just more risk of more churn and possibly another 5% decline. So this is just not the place to get bullish. And again, if you want to layer on calls or you want to sell stocks that have not done well of late, that's the kind of thing we'd be doing. And if you're a hedge fund and you want to get short, far rather do that here than when we're down 5%. One thing we want to be really keeping a close watch on is the tech sector, because that sector was one of the key ingredients in our analysis in March to tell us that there was prospects for a 5% or so correction into April, and the tech sector has gone back across the range with the S&P out to new highs, but we are actually not seeing the repair work that we need to see in this very important leadership sector to tell us that things are the green light is upon us and that we can start to take risk even though we're overbought. So the tech sector is something that we're going to really want to be mindful of, and I'll walk you through what I'll be watching for in the coming months. So when we're thinking about the research process and managing portfolios and speaking with clients, ultimately the question that we're always trying to answer is, should we be taking risk, and if so, how much? And we try to answer that question consistently without really altering the path we take to answer that question, because we think there are some things that you can rely on systematically throughout the course of a cycle to guide you as to whether or not you should be taking risk and how much. So the first thing we always want to be able to assess is what kind of a regime are we in? Is this a regime that supports up, like a bull market? Does it support down or a bear market, or is it more like a range bound, multi-month sort of sideways affair? And the way we think about it is, and I think we talked about this in last month's video, but I believe that there's always enough evidence on the table to eliminate one of these three scenarios. And I don't think you can ever really eliminate sideways, because the market can just trace sideways all of a sudden for any reason without warning, quite frankly. So what we're really trying to do is we're trying to eliminate up or down. And once we can do that, then we can invest for the remaining two scenarios. So if we can eliminate sustainably down, which I do think is the case. So if we're down 5%, that's why I want to be buying when we're down 5%, because I don't think we go further than that. Maybe we go down 10%, but it's not a 20 or 30 or 40% decline. And so when we can eliminate down, we're left with sideways to up. And I think that's the environment we're in. And so the answer to the question is yes, you should be taking risk. There's no debating that, at least as far as we're concerned in our systematic research process. The idea, though, is that even in the most robust bull markets, you don't just go up in a straight line. And so can we identify these windows where there's risk of a tactical decline? And again, that's not that it would be bearish. It's just like if you're not fully invested and you're thinking of putting a slug of cash to work, if you're in an environment where the tactical risks are greater, you just may want to be more mindful of that, and you want to be buying when we're oversold. And so the question is, tactical, when should you be tactical? And if you should be tactical, where should you do so? And that's the question. That's that second layer of questions that we're trying to answer. And then the third one is, and this is really pervasive, it's always the case, stock selection. What should we be buying? And it is dependent on the regime, and it is dependent on the tactical nature of things, because that does drive what's relatively outperforming. But ultimately, you want a systematic process to identify what you should be buying. And that if it's a robust systematic process, that those stocks that are percolating up to the top of that buy list or that watch list, which I'll show you in a moment, that what's percolating up to the top of that buy list or watch list should be reflective of the regime that we're in. So let's handle these one at a time. So regime, up, down, or sideways. Most should know by now that the way we deal with this, as always, is of course systematic, but we handle it predominantly with this risk gauge. And just quickly to remind you once again, we follow 2,800 stocks in the US. We also do this across the globe, so another 4,000 or so stocks around the globe. We map the globe just like you see here in the US, which I'm showing you here. And we're measuring these. We're assessing these 2,800 stocks across 3 timeframes, across 5 metrics that have the same characteristics throughout a full cycle. So this is market trend, market trend, relative performance, momentum, breadth, and volatility. Those 5 things behave the same in all bull markets, all bear markets across the regimes, and transitioning from one regime to the other, these things have the same type of behavior. And because they're so consistent like that, we're comfortable building systematic models around those that we can really lean on to help guide us through these cycles as they unfold. And when you look at the current readings, they're all mixed, but they're in the top half of mixed. And as you've been following this in our weekly notes, in our charting my interruptions, and even in prior videos, we know that these various timeframes, and short term again is the weekly, monthly, and quarterly. We know that they've been kind of oscillating in this high mixed to low risk on. So this is kind of teetering on a bull market environment. But as I said earlier, it's not super robust. And this is a systematic quantitative way of showing you that it's just not really quite ready for prime time. And all of which, again, is fine. It's just, it's not bearish, so it leaves us with that sort of sideways to up. And when you look at as I said, there's 5 components to this risk gauge, one of which is trend. And I always show the trend attached to the risk gauge, just to give an update as to where we are. And as of May 24th, this past Friday, we can see that 56% of that long-term quarterly time frame, 56% are in an uptrend, 63% of the monthly charts are in an uptrend, and now with the rally back across the range, we're now with 56% of the weekly charts are also in uptrend. So we're now in the majority of charts in an uptrend. And one might ask, well, why would that not be robust enough to just expect the market to kind of blast off from here, because it's the majority across the range, across the timeframes? But the reality is, when we're talking about overbought and the resumption of a new bull move, we want it to be very overbought. We want it to be so overbought that it's uncomfortable. It's like, this is really hard to buy because it's so overbought. And what we're showing you here is that's just not the case. In fact, with the S&P near its highs, we actually have only 37% of the markets above its 15-day moving average, and only 50% of the markets above its 50-day average. So that's just not super robust. And I think this combination of risk gauge in this primary component here of the trend itself, it's leaning bullish, but it's just not really robust. So this is just about being tactical, and this is just not where you want to pile in on the long side. So we're kind of left with a sideways to up expectation here, and we just want to be tactical about that. So on to the next one. If we want to be tactical, which is the case, where do we want to be tactical in that framework? So if you look at the resistance zones and the momentum zones and the support zones that we systematically derive for each of these markets and the stocks and the ETFs and stuff that we follow, remember the resistance zones, this is the zone that needs to be exceeded in order to perpetuate or keep the trend going. And if you're in an uptrend, which you can see here across the 3 timeframes for the S&P, we're in an uptrend across all 3 timeframes. This momentum zone is the zone of support that needs to hold in order to keep the momentum of that zone, that time frame going. Now the trick here, as you can see, is that the S&P itself is in an uptrend, but as I just showed you, the just a very slight majority of the market is in an uptrend, and actually over half the charts in the weekly time frame actually still show negative momentum. So although they're trending, the momentum is kind of faltering, and again, it's just not as good as it looks like here on the surface. And this is what we're looking for. We're looking for the S&P to show promise, but we need evidence that the gas tank is full and that this car is ready to drive in a robust way, like it did off of the October bottom. And this is just not what we're seeing. So again, there's just this disconnect between what the index is saying and what the breadth is saying. So the car looks great, but the tank is not full. It's not really ready for a cross the country journey like this. It's more, again, in the back roads looking for a gas station, if you will. So when you look at the resistance zones, although we're trending, we're still right now, as far as the S&P is concerned, and the Spider ETF representing the S&P, we're right in the middle of that zone where it's really, this is where the rubber meets the road, and we really need to start to show momentum from beneath the surface to really catalyze this breakout and move us higher from here. So we're just in monitor mode, and we're sitting on 10 or 12% cash, and happy to do that because the stocks that we've been recommending are higher beta to begin with. So even though we might have cash on hand, our beta adjusted long exposure is actually a bit longer than 100%. So we have plenty of exposure to the market. This just isn't right here is just not where we want to really pile into the market here, as I've been saying. So lastly, then, therefore, if we want to be long, we want to be, just being tactically mindful as we're building out that long exposure. We get that. The next question, of course, is what do we want to be long? And I'm just going to take a moment to kind of walk you through how I do this and how I develop the momentum. The weekly motor chart packs, and how do I generate these ideas, and why do these ideas make it into these onto these watch lists and into the motor weekly motor chart packs, etc. So this is about a 25-year back test that kind of it's the backbone to the research process in terms of the watch list that we generate, and then pick stocks for either in portfolios or the watch list that we generate for the motor research and motor access products. So what we're looking at here is the performance of the essence of the back test of what we do, which is a combination of momentum, relative performance, price trend, volatility, and fundamental quality, and just rebalancing those things as they shift over time. This is not a monthly rebalance; it's kind of like rebalances on the fly. This blue line represents the performance of that combination of these things. And again, all of these things, as you can tell, they're all things that pretty much must be true in order for a stock to have an opportunity to really trend higher sustainably. It needs to be leadership. It has to have momentum. It has to have relative performance. Obviously, if it's trending higher, it has to have a positive trend. And it tends to have a certain volatility profile. And because prices don't just go up in a vacuum, they need fundamentals to drive them higher. It's those combination of things that this test is based on. And the orange line is the S&P itself, which has done what it's done over the past 20 or 25 years. And the gray line, of course, is the performance spread between the two. So again, it's out of this list, the stocks that are become candidates to be in this back test. This is where we generate our buy ideas from for the weekly motor chart pack. So just to kind of give you some context, and when you see this chart pack come through each week in the weekly research, this is where it comes from. And this is the type of thing, the types of opportunities we're trying to target. So as always, there's a method to my madness, and there's a reason why I do these things. And obviously, the performance potential, this is not a promise or anything like that, but of course, there's a potential for this kind of performance. But there's other research benefits that come from thinking about the world this way, because then we can say, well, if we have this watch list that supposedly calls this list of names that has the potential to do well, we can then ask the simple next logical question. Okay, well, what's on that watch list? And so before I dig too deeply into that, this is the sector table that you should hopefully be quite familiar with by now. And I just very quickly want to I say this almost every month, and I'm thankful that I can, because it's bullish. But when you look at what's leading, here's the leading sectors, 1 through 6. They're all cyclical, and yes, they've been rotating, they've been kind of switching spots, but they've been maintaining a largely robust cyclical high beta nature to them, which again is, if you believe that the market is good at looking forward in assessing the macro landscape months, quarters ahead, and if you believe it's good at doing that, you have to ask yourself, well, if it's pulling all of these cyclical sectors to the top of the leaderboard, why would it be doing that if it saw something that it was concerned about down the road? And so obviously that has to be a fundamental philosophical perspective that you must share to be able to draw that conclusion. But of course, as a trend following investor, that's how I think about the world. The market would not have these 5 or 6 sectors as leaders if it was looking forward 6 to 12 months and was concerned about something. So that might be uncomfortable to accept, given when we as investors look out over the horizon, we look at the wars and the inflation and what's the Fed going to do, and inverted yield curve and potential recessions and everything else. That's very uncomfortable to assess personally. But everything I just listed, the market knows about all of that. It also knows about all the stuff that we don't even know that we don't know, right? So this is something I say repeatedly, but it's worth repeating because it's a fundamental core tenet to my philosophy of how the market behaves and in what it does and what drives it higher and what drives it lower. And right now, the conditions are positive. As I've said, it's not robust, but it's definitely positive. And so if that's the case, we want to be mindful of that and just track things 5% swing at a time. And when we look at all the industries that are within these leadership sectors, we can see that, for instance, 90% of the industries that are in the finance sector are outperforming the market. And then as you follow the list down, 5 of the leadership sectors show the majority of their constituent industries are outperforming. So again, this isn't just a handful of industries within some sectors that are leading. I mean, it's broad, it's cyclical, and it's broad across the cyclical sector. So it's quite robust. And then when you look at the percentage of stocks across the various timeframes within each of those sectors, you can see that the vast majority of the stocks within these sectors are in uptrends across the timeframes. Now, to make my point about how although all of that's positive, right? To make my point about how it's also simultaneously not super robust, when you look at that perspective from the sectors that are underperforming, first and foremost, as I showed you earlier, at the market level, it's not super robust. I mean, it's the majority, yes. So it's hard to be bearish and can sustain losses from here when you have most stocks trending. And at the margin, it's getting better and better as time goes on. But when you look at the sectors that are underperforming, most of them are actually in long-term downtrend still. So when we're in a true robust bull market, this will be fixed, but it's not fixed right now. And until it's fixed, we just want to be mindful that corrections are more likely. And they can be painful from time to time, just like we saw back in April. So having said all that, let's get back to this notion of watch list. So how can we use this watch list, which is part of our research process? How can we use that to gauge just how robust and how strong the various leadership sectors are? So when we do this, we can say that, for instance, in the financial sector, when we're looking at this watch list, first and foremost, we can see that 22% of the roughly 2,800 stocks that are in the motor universe, 22% of them are on this watch list. So 22% of the stocks across the motor universe have the criteria to be potential leaders. So this again is combinations of momentum and trend, et cetera. So 1 in 5 stocks across the market qualify for this watch list. Great. So when we have that list built, we can now say, well, what percent of the financial sector is on that list? 33% of the financial sector is on that list. That's a large swath. 35% of industrials, and as you go down further, 26% of tech, et cetera. So this is pretty robust representation of these leadership sectors on this watch list. So once again, confirming the idea that this is a strong breadth environment, at least within the leadership, right? So then we can also say, well, when we look at this 22% of the market that's on this watch list, let's just look at those stocks alone and let's just see where they are. So 21% of the stocks that are on the watch list are in the financial sector. And then as you go down, it's 19% of the stocks on the watch list are from the industrial sector. So this can be a little confusing. So I'm going to just give you one more example. 35% of the industrial sector is on the watch list. When you look at that 35% of the industrial sector, that represents 19% of the total watch list, right? So when you go down the list, you can see that it begins to thin out a bit as you go further down. But this one, I think, is the one that we want to watch because there's it's like roughly 20 or so percent of the motor universe are tech stocks. And that's an important comparator because now we can say that only 14% of the watch list is tech. So in essence, tech, although it's leadership, it's actually underrepresented on this watch list relative to the size of the tech sector in the broad universe. So once again, This isn't bearish. It could be just about rotation away from tech and into other leadership sectors, which is quite possible what's going on, but it's still worth monitoring going forward, because tech is indeed, of course, especially these days, is a very important sector to watch. So I still think we should have tech exposure. There's plenty of ideas within the tech sector, but in terms of being robustly represented on the leadership board, it simply isn't. And then I'll show you some charts on that in a moment. So once we know what's going on at the sector level, we can then also look at this from the industry level, right? Same idea, right? So we're just taking the industries that have the largest percentage of their constituents on the watch list. And so I'm just showing you all of the industries that have at least half of their constituents on the watch list. And when you look at this list, it's quite cyclical. It's a lot of growth. There's a lot of cyclicality. There's certainly a lot of beta, a lot of quality names in here as well. And so again, if you believe that the market's good, at looking forward and saying the relatively near-term future looks either robust or something to be concerned about, and if you believe that, and then you look at how this is positioned, it's just hard to be bearish. Do you have to be uber bullish? No, this could just be sideways, but even in a sideways environment, I don't want to be bearish. I just want to be more mindful about when I'm pressing long bets versus not. But when I look at this, I just don't see an environment where I want to necessarily be bearish. Maybe, as I showed you earlier, reserve our aggressive buying for when we're oversold. Yeah, I can see that for sure. Broadly speaking, when you look at the other models, but this particular slide just tells me that there's nothing, as far as I can tell, that's worth being necessarily bearish about, which again can be hard to swallow, because given everything we know about the future and just how crazy the world seems right now. But all of that the market knows. Plus, as I said, all the stuff we don't know that we should know, but the market does know it, and this is knowing everything it knows. This is how it looks. Okay, so before we wrap up, let's just take a quick look at the tech sector and why I think it's important to watch. So if you recall, back in March, we were writing about how the tech sector was breaking out to new highs, but its relative performance was beginning to flag, and its breadth was beginning to flag. So this red line down here is a percentage of stocks in the tech sector that are above their 50-day moving average. So with a combination of relative performance beginning to not hit new highs with the sector, and its breadth not hitting new highs with the sector in such an important sector, this was one of the ingredients, one of the several ingredients we pointed to say that there's a higher risk of a correction into April, and if you want to get bearish or if you want to get short, do so now, because you don't want to be doing it when the market's down 5%, because the bigger picture view remains bullish. And if we get down 5%, you want to be doing your buying then, not your selling. So we now have the benefit of being able to fast forward through that, because we went through that window, and we now know the S&P is out to new highs. And we also know that the tech sector is out to new highs, which sounds good. In fact, obviously, all else being equal, it is good. But there's a lot more to it than that. We want to know, for instance, is the relative performance confirming the highs of the index? And we can see that it's not. And we can also see that the breadth continues to falter and is nowhere near as robust as it was back in to start the last move higher, as I'll show you in a moment. So this is just more continuous divergent behavior in a very important sector. And as I wrote last week about how NVIDIA was breaking out to new highs, and while in the morning of that breakout, I think all of the Mag 7 stocks were actually down on the day. So that's just a very micro example of how divergent even the tech sector is. So as tempting as it is to just pile in because the tech sector is breaking out, the S&P is breaking out, the truth is, or at least from our perspective, what we can see is that the underpinnings, in the analogy that I've been using, is the gas tank is just not full. So the risk is that this car is going to run out of gas, and so therefore don't pile into it, because it's not ready for a long journey across the market landscape. So what we're looking for leadership to give us indications that this is leadership still, right? If you recall back in the correction of last fall, even the leadership of a market will fully participate in the market's corrections, as we saw tech do here. We saw it do so back here as well. and you saw that the breadth continued to get worse and worse through that correction, where you had less than 10% of the S&P of the tech sector was above its 50-day moving average. So there was basically virtually no stocks left untouched in the tech sector. So, but what we're looking for while that's ongoing is what's most important is while that was ongoing, the relative performance of the tech sector began to turn up, and it began to show strength in the throes of a pretty violent tactical correction. That's what you're looking for, and as you can see, that's not what we're seeing here. And even better back then was as the relative performance began to break out to new highs, the tech sector itself wasn't even at new highs yet. So this is the kind of robust early indication that you're looking for leadership to tell you that the market's ready to go. Leadership is ready to take the baton back from the bears and just kind of drive this thing higher. We don't see that. So when we look at all of the cyclical sectors that have the potential to take the market higher in a traditional, next leg higher of a bull market, we don't see any sectors that look like this. That's not to say that we need to see a sector look like this before the market can take off, because the market can do frankly anything it wants to do. But if we're looking for evidence that it's ready to do so now, this is a good, kind of set of circumstances that would give us an early warning that the market's ready to go higher. And when we look at the 5 sectors or 6 sectors that have the potential to do this, we don't see it from any of them. So it just keeps us more anchored in our view that the market's just not ready for prime time yet. And so when we just take a moment to summarize here, we remain longer term bullish. It's just a matter of, given the tactical nature of the structure of the market right now, we're just not comfortable pressing bullish bets up here when we're back across the range without really having clear leadership and certainly not having repaired the structural damage that was done during the April decline. So we added to our long exposure back in April. We're now back across the range. We don't feel compelled at all to add to long exposure up here. We prefer to just kind of go into monitor mode and watch to see how this kind of movie plays out here. So we're comfortable holding some cash here. This is definitely not about going to 50% cash, but having some cash, 10, 15% is fine, especially given that most of what's working and most of what's on that watch list is higher beta by nature. When you adjust your long exposure for beta, you could actually be 105, 110% long here, even though you might have some cash on. So again, I want to stress, this isn't about 50% cash or 20% net short, because this is definitely not that environment. It's just being tactical about when and where you deploy your cash, and being overbought and across the range without having done adequate repair work. This just is not where you want to be putting that 10 or 15% cash to work. So until we get the green light from our systematic research process, which is that risk gauge that I spoke to earlier, as well as key sectors like tech and industrials and energy and things like that, really kind of giving us an indication that they're ready to go. We just want to continue to do the maintenance and kind of like pulling the weeds and watering the flowers and just kind of keeping the portfolio fresh. So anything that's kind of come across the range, but it has done so, maybe hitting new relative lows, move that stock on and replace it with something. Sure, don't raise substantial cash here by just selling what's not working. If you've got a stock that has a good setup and is oversold itself and maybe it is a component of that watch list, which you'll see these appearing in the weekly MOTR chart packs, maybe just breaking out or something like that, but just rotating into something like that and away from a name that's been flagging and maybe hitting meaningful 52-week relative lows or something. Move on from those names and rotate into something that's working, but not in a wholesale fashion, not like 10 or 15% cash getting it involved up here. So just just upgrading, pruning, things like that is fine up here. I'd rather be really putting that 10 to 15% cash to work on the next oversold. I'm still okay as well with the idea of maybe selling some calls against some of the holdings that we have, especially ones that haven't broken out yet, and maybe even selling some puts at prices down below, out of the money, that where you wouldn't mind taking on some additional exposure to your current holdings, but you get paid the put premium as a source of income while the market's kind of going through this churning, chopping window of time. So that's kind of our view for now. Nothing's really changed. It just, as much as we'd love to say that that rally across the range fixed everything, it didn't. So again, that's not bearish. It's just not ready for prime time, and that's the essence of the of this video. So thanks so much for watching this month and tuning in. Really appreciate your time here, and that's all I got for you this month. So we'll catch up with you next month, and if I can help with anything, here's my email. Please feel free to reach out to me. Thanks so much.